Financial Accounting 2. Study Session 1. Introduction. In our previous study, you should notice that accounting has been described as the process of generating economic information to permit informed judgment and decision by users of accounting information. Manufacturing accounts. A manufacturing account is an account prepared for organizations that are engaged in the production of goods. It is prepared in addition to the trading, profit, and loss accounts. The manufacturing account, which is produced basically for internal use, is employed to show the cost of manufacture or production during the period under review. From this, you can summarize the objective of a manufacturing account as 1. Discloses the total cost of manufacture or production. 2. Establishes a basis for evaluating the efficiency of manufacturing. Classification of cost of goods produced. It is divided into different types according to their nature and behavior in relation to the volume of production. 1. Raw materials. 2. Direct labor. 3. Direct expenses. 4. Indirect cost. 5. Work in progress. Manufacturing profit or loss. Profit on manufacture is the cost saved by the organization for manufacturing instead of purchasing, while loss is the additional cost incurred by the organization for manufacturing instead of purchasing. When profit is ascertained on manufacture, the relative advantage of manufacturing over buying goods for resale would have been established. In this study session, please note the following. 1. Manufacturing account is an account prepared for organizations that are engaged in the production of goods. It is prepared in addition to the trading, profit, and loss accounts. 2. The manufacturing account, which is produced basically for internal use, is employed to show the cost of manufacture or production during the period under review. 3. Manufacturing concerns will choose the option of producing goods if the cost of doing so is lower than the cost of buying the same goods in their finished state. 4. The cost of production is the total cost incurred in bringing the goods from the raw material stage to the finished goods state. 5. Cost of production is divided into different types according to their nature and behavior in relation to the volume of production, which are direct materials, direct labor, prime cost, direct expense, and cost of goods produced. 6. Profit on manufacture is the cost saved by the organization for manufacturing instead of purchasing. Study Session 2. Investment Accounts. Introduction. In finance, an investment is a monetary asset, purchased with the idea that the asset will provide income in the future or appreciate and be sold at a higher price. In this study session, you will learn investment in accounting, and the nature of investment in accounting. Investment accounts. In accounting, investments are assets acquired by an enterprise for purposes of capital appreciation, or income generation without any activities in the form of production, trade, or provision of services. Such investment could be in the form of equity securities, debt securities, or investment in tangible assets such as land and building. Companies and individuals hold an investment in stock of shares and debentures. The reason for holding investment includes 1. As a main business of the company, for example, investment in unit trust company. 2. As a temporary holds for profit making when such investments are disposed of. 3. As a means of providing funds for expansion. Classification of investments. According to International Accounting Standards 40, a reporting enterprise should classify its investment into 1. Short-term investment. 2. Long-term investment. 3. Investment property. Nature of investment. An investment could be either 1. Fixed interest securities. 2. Variable interest stocks. Profit or loss on disposal of investment. Whenever there is a disposal of an investment, the profit or loss on such disposal must be calculated. In a situation like this, two methods are used in calculating the cost, and they are 1. The weighted average cost of sales. This method is recommended. 2. The first in first out method. In this study session, please note the following. 1. Investments are assets acquired by an enterprise for purposes of capital appreciation or income generation without any activities in the form of production, trade, or provision of services. 2. Companies and individuals hold investments in stock of shares and debentures. 3. According to International Accounting Standards 40, a reporting enterprise should classify its investment into 1. Short-term or current investments. 2. Long-term investments. 3. Investment properties. 5. An investment could be either 1. Fixed interest securities. 2. Variable interest stocks or security. Study Session 3. Interpretation of accounting statements, accounting ratios. Introduction. It is pertinent to know that corporate or individual performance does help us to make decisions that will have present and future implications on the welfare and well-being of the individual or corporate organization. Financial analysis. Financial analysis is the selection, evaluation, and interpretation of financial data, along with other pertinent information, to assist management in investment and financial decision-making. Financial analysis may be used, both internally and externally, depending on the requirements of any potential decision. Such internal use entails an evaluation of employees' performance, efficiency of operation, or financial state of the organization, among others. Users of accounting ratios. The following users of accounting ratios are critical in the use of ratios. 1. Management. 2. Tax inspectors. 3. Potential investors. 4. Shareholders. 5. Bank and trade creditors. 6. Employees. 7. Communities situated around the location of the company. 8. Financial analysts. Definition of accounting ratios. A ratio is a mathematical relation, or expression between one quantity and another quantity. Accounting ratios are critical, invaluable pointers to the success or failure of a business organization. Though used by analysts in evaluating an organization, they are primarily used by higher levels of management who are responsible for maximizing profits and planning for the future. It should however be emphasized at this point that ratios generally are only a guide and cannot form the basis of definitive statements. Uses of accounting ratios. These are as follows. 1. Ratios have the following uses, which, however, are not exhaustive. 2. Past ratios indicate trends in cost, profit, sales, and other important variables, and so they can be used for planning and control purposes. 3. Ideal ratios may be established, and these can serve as benchmarks. 4. Ratios computed are a communication designed to inform. They inform what has happened and what will happen. 5. Ratios can act as efficiency measures when trends are disclosed in an inter-organization or intra-organization comparison. Classification of accounting ratios. Ratios may be grouped according to whether they are derived from the balance sheet or profit and loss account, or income statement. 1. Balance sheet classification. 2. Profit and loss classification. However, ratios may be grouped into the following. 1. Profitability or efficiency ratio. 2. Liquidity or solvency ratio. 3. Leverage or long-term solvency ratios. 4. Activity ratios. Each of the above classifications, or groups, can be further subdivided. However, let us look at what each means. 1. Profitability ratio or efficiency ratio. This indicates the measure of a company's operating success. The subdivisions under profitability ratio include 1. Gross profit and net profit margin. 2. Net profit margin. 3. Operating profit margin. 4. Return on capital employed. 5. Sales to total assets. 6. Inventory turnover. 7. Debtors collection period. 8. Debtors turnover. 9. Creditors payment period. 10. Creditors turnover. Liquidity ratios. These financial obligations are expected to be short-term maturing obligations. The following are some of the ratios in this classification. 1. Current ratio. 2. Quick assets ratio. 3. Cash ratio. Leverage ratios. These ratios are when a company uses fixed interest securities to finance its operations. The following are some of the ratios in this category. 1. Debt ratio. 2. Debt to equity ratio. 3. Total debt to shareholder funds. 4. Fixed interest coverage ratios. Investment ratios. These are also known as shareholders' ratios because they are used by shareholders to assess the quality and value of an investment in the equity shares by a company. The ratios under this category include 1. Earnings per share. 2. Dividend per share. 3. Earnings yield. 4. Dividend yield. 5. Price or earnings ratio. 6. Dividend cover. In this study session, please note the following. 1. Financial analysis is the selection, evaluation, and interpretation of financial data, along with other pertinent information, to assist management in investment and financial decision-making. 2. Financial analysis may be used, both internally and externally, depending on the requirements of any potential decision. 3. An accounting ratio, therefore, is a comparison between one quantity of accounting, or financial information and another quantity of accounting financial information. 4. Financial data reveal significant relationships between data and trends in those data assess the organization's past performances and current financial positions. 5. This classification of ratio measures the solvency, or ability of a company or firm to meet financial obligations as they fall due. 4. Financial analysis, cash flow statement. Introduction. This is a statement of changes in financial position on a cash basis. It summarizes the courses of changes in cash position between dates of two balance sheets in different financial periods. Cash flow statement. Cash flow statements are a valuable source of information. However, there are certain important non-cash transactions that may occur during a year that would not be reported in a cash flow statement. Examples of such transactions include: 1. Bonus issues of shares. 2. Acquisition of assets under finance leases. 3. Conversions of debt to equity. 4. Asset revaluations are recognized in the financial statements. 5. The issues of shares in a share exchange. 6. The share exchange above may lead to an acquisition, and this would result in assets being acquired that are not reflected as cash flows. Purposes of producing a cash flow statement. Financial Reporting Standard No. 1 provides that companies should provide information that assists in the assessment of their liquidity, solvency, and financial adaptability. A company's financial adaptability is defined by the statement of principles as its ability to take effective action to alter the amount and timing of its cash flows so that it can respond to unexpected needs or opportunities. The cash flow statement provides such information, giving much more detail about the sources and uses of cash during an accounting period than can be found in either 1. The profit and loss account for the period, which is prepared in accordance with the accruals concept. 2. The balance sheet, which shows only a snapshot of the company's financial position at the end of the period. Terminologies. There are certain terms used in the cash flow statement. 1. Cash. 2. Cash equivalents. 3. Cash flows. Methods of preparing a statement of cash flows. There are two methods of preparing a statement of cash flows. They are the direct method and the indirect method. The direct method is the easiest and recommended. This is because the use of the direct method improves the quality of financial reporting and enables users to appreciate cash flow information more readily. For this reason, the direct method is adopted in this textbook. In this study session, please note the following. 1. Cash flow statements are a valuable source of information. 2. There are certain important non-cash transactions that may occur during a year that would not be reported in a cash flow statement. 3. Financial Reporting Standard No. 1 provides that companies should provide information that assists in the assessment of their liquidity, solvency and financial adaptability. 4. A company's financial adaptability is defined by the statement of principles as its ability to take effective action to alter the amount and timing of its cash flows so that it can respond to unexpected needs or opportunities. 5. There are certain terms used in the cash flow statement, which are cash, cash equivalents, and cash flows.